Question?
In August of 2007, the first German bank went down, having commercial paper conduit with over $20 billion worth of U.S. mortgage-backed securities. At that point, it shut down the U.S. commercial loan securitization market, and at least 2 or 3 more German banks followed, somewhere between 45 to 65 billion, causing the mark-to-market effect to the U.S., which I think really drove our housing prices down. So I guess my question to the panel is, first, fraud is really sort of reduced when you look at the frozen liquidity markets as a factor, and secondly, what do we do about the failure of German and foreign regulators, which it seems nobody has addressed or even discusses as having any portion of this? And secondarily, if another big question, if you care to answer, is with the commercial loan market, high leverage loan market securitization shut down, there's about $1 trillion that need to be refinanced, with 60% of the financing market gone. Are we headed towards another crisis for commercial loans?
I'll just comment that we do definitely have, already had, a double bubble. There was a bubble in house prices. There was a bubble lagging 6 quarters in commercial real estate, and we're going to suffer a lot, and that's very largely in the highly regulated banking system. But it's also, your point about the Europeans is absolutely right. The Europeans were heavy buyers, not only German banks, but including the German banks, and the state-owned, that is to say, the federally state-owned German banks, the Landesbanken in particular, made big purchases in these troubled securities markets, and they're certainly part of the story. Look, you can't have a bubble without some kind of investors who come in size and are fooled, as is clear in retrospect.
You shouldn't assume that fraud had to have anything to do with liquidity. After all, the defining element at law of fraud that separates it from other forms of theft is deceit. So fraud is all about, I create trust in you, the victim, and then I betray that trust. And there's nothing more effective in eroding trust, which is critical to financial markets, than exactly that kind of fraud. So we're all at an event where we get something like this. What happens if we know that 1 in 100 of these bottles is contaminated? How many of us are going to drink? Long before fraud becomes endemic, bankers start not trusting other bankers. And it was bankers that shut down all of these markets, not regulators, because they no longer trusted the financial statements of other bankers.
And the banking system is not the financial system in its entirety. It's something less than half of it. So money comes out of money market funds every week. It goes to PIMCO. For the most part, loan markets are open, and it has been sort of movement from money market fund to PIMCO, and PIMCO is intermediating that instead of J.P. Morgan, BAC, structured finance vehicles. So I think it's likely that the credit markets, barring sort of further accident, further policy sort of confusion, mistake, destruction, the likelihood is that good solvent businesses will have open financing markets, for a while until the next bust.
Yeah, it's very interesting what happened in Europe, and it's interesting that it didn't happen here. You may remember when the financial crisis first happened, the Europeans were laughing at us. And then all of a sudden, European banks went down. And the reason was that the Europeans had implemented Basel, which is this international agreement on how much capital you're supposed to have. And they'd used a lot of mathematical models to determine how much capital they had. Fortunately, it hadn't been fully implemented in the U.S. And what it meant, the European banks had no capital. So when they started liquidating down, they all started going bust. Now, how did they make such big mistakes in the bond market? Because Standard & Poor's, Moody's, and Fitch had misrated these financial instruments. Now, Standard & Poor's, Moody's, and Fitch are government-sanctioned oligopoly. They're the only people that can rate instruments for pension funds. And they didn't just miss like they rated them A's and they were B's. They rated A's, they were F's. And so they missed on a huge scale. But they had this sanction from the SEC, and if I'm a European, I can rely on this government-sanctioned Standard & Poor's, Moody's, and Fitch to rely on this instrument. And they got hugely misread by the ratings. Almost everything that failed had been rated relatively low risk by these rating agencies that impacted the European market.
Including AIG.
Including AIG. AIG was AAA rated till they were broke.
Well, but let's be candid. Let's be candid about Basel. Basel weakened, not strengthened, capital standards on stuff rated AAA at the direct request of the banks and the central bankers who are so close to the banks. So the banks got what they wanted, and it's the old be careful what you ask for.
Gene, did you have a question?
I was curious, were the people who borrowed, either the individuals who borrowed the subprime loans or lower downstream, the lenders, were either one being irrational?
In retrospect, it's easy to see mistakes that are made. I like to tell the following story, which was put to me by a friend of mine. He said, if you were buying a house you couldn't afford in California in 2002, and you had two choices, you could have a standard, old-fashioned 30-year fixed-rate loan and make a 20% down payment, or you could have a 100% LTV, no down payment, subprime loan. Let's make it even an option pay arm where you don't even have to pay all the interest. In 2002, which was the smarter financial decision on the part of the borrower? And the answer is to take the risky subprime, no down payment loan. You got tremendous appreciation in the asset. You didn't have to put any cash in. You didn't have to pay much debt service. You got, speaking of grades, you got an A in finance for how to leverage up yourself, and you won. It's even true if you were buying that house in 2006 at the peak, because if you had the standard old loan, you had a much bigger loss of your own cash when the price of the house went down than did the guy who put up 20% and paid a lot of interest along the way. So the cases vary case by case, and sometimes people are cleverer than we think.
One final question?
This has to do with capital. We hear a lot of talk, and we've heard it from the panel, about banks and other intermediaries ought to have greater capital. And yet, my calculation is that the pre-tax cost of capital per dollar is about 4 to 6 times the pre-tax cost of a dollar of debt. There's obviously a powerful incentive then for the financial engineers to figure out how to set up funding structures that minimize the amount of equity capital, costly equity capital, in a funding structure. So my question for the panel is, how do you square the cry for higher capital with the fact that, largely because of the tax code, equity capital is so much more expensive? Isn't there a disconnect there? Isn't it, if we want to have more equity capital in funding structures, there has to be some major adjustments in the tax code that makes equity less expensive and debt more expensive?
Totally, and unless you're going to force it on the system, which is, if you're going to have this too big to fail, you're going to end up forcing it. But my answer is simple: make dividends tax deductible to the corporation, and that will close a huge portion of the cost differential. If you look at it, most of the time, it's the leverage around debt is the taxes.
Let's thank our panelists for a terrific presentation.